Right, so hello and welcome to this week's workshop. So if today's your first day, my name's Phil Newton. I've been trading full-time since around 2001, hand drawing charts since the 90s. I've been managing private clients' accounts for most of that time. And I've been doing this a while is all I'm really trying to get around to. If you want to know more about me, I'm pretty open. I'm not going to spend hours talking about this, but it's just really to point out that it's not my first rodeo, is really what the kids like to say these days. Right, so let's just get myself back on track. Where's my little schedule? Right, so we've gone through market overview. We've reviewed some of the positions, and let's think about hedging with options. So while I take a quick drink and just get my option station open, what do you know about options? Just give me a little show of hands. 1, 2, or 3 are going to be the responses, or if you feel like typing it. Are options brand new? You're not used to them? Put a 1 in the chat box. If you're familiar with options, give me a 2. And if you're an old hand at options and you're familiar with lots of different types of strategies, just give me a 3. I just want to kind of get a feel for where we're at so I can either pare back or tone things up. So 1 to 2, a couple of 3s. Awesome. So we've got a bit of a mix. Most people, as I'm looking through the chat box, they're somewhere between options are brand new to I'm familiar with some strategies, but not too experienced. Okay, so there's 1 or 2 3s in there. Just in the interest of a slower pace so that we don't go too fast, I am going to be talking I'll try and phrase things so that the novices can understand, and I'll try and at the same time, I will be going through some advanced tactics. So it will give you some ideas and inspiration for if you're already familiar with options and strategies, then we can nerd out a little bit at the end. So I'll try and touch bases for everyone ultimately. So options then, options. Options are, if they're brand new for you, so everyone whose options are brand new, the best way of thinking about options is, well, I'm preempting the eye roll that the people who are experienced with them are going to give me. It's not entirely accurate, but it just helps you to kind of get a grasp of the concept of what options are and what they can do. And the best way of thinking about them is they're like deposits. And certainly on the buy side, they're like a deposit. If you were going to buy a car and you said to the car dealer, I want that car, it's got the right spec, it's the right color, but I'm not going to buy it until the end of the month. And they would say, certainly, sir, madam, just leave a deposit. And you would give them 10%, and now you control the car. And that's a deposit. And we're all familiar with that in the real world. And stock options work in a similar way. And again, I appreciate it's not entirely accurate. There is some differences, but just to kind of get the concept of what an option is on stocks, you're already familiar with the concept. We use them in lots of different areas, lots of different walks of life. They're quite big in the real estate world. There's similar things there. Ultimately, you're probably already familiar with a lot of concepts, or what most people consider advanced concepts, because they're in every facet of life already. So an option in stock options cases, you have, just like a deposit on a car, you control the car, you don't own the car. And we would reserve 100 shares. We control 100 shares, but we don't need to own them. Now, if it turned out that in our car example, Steve McQueen used to own that car, then the value of the car will increase. Now, as a result of that, the value of our deposit would also increase. We could sell the deposit to someone else who wants the car. You may say, you know what, Steve McQueen used to own this car, and it's now worth $1 million. Maybe I can sell the deposit. I don't need to buy the car, but you control the car at the lower price. And that's the key point there. You control the car at the lower price because you've reserved it at the lower price, but it's worth more. So you can either buy the car at the cheap price and flip it quite quickly, or you can own the car that Steve McQueen owns, or you can sell the deposits. Now, what I like to do is buy and sell the deposits back and forth. I'm never going to take delivery of the stock. I just want to use the option or the deposit as an alternative to buying stock because it's more it's less capital intensive. I don't need to put up the, $100,000 to buy a car that Steve McQueen may have owned. I can just control it for a few thousand, a fraction of the cost, 10%. So that's the power of options for me. It just allows me to be more savvy with the capital and the cash that I have available. And these days, there's no margin requirements. If your option is worth $100, the deposits, then your margin requirement is $100. You don't need any extra cash. And that's what makes it capital efficient. So it's very, very easy to get a grip of that idea that they're just like a deposit. So how does this help us in the stock world? Because we're going to focus on options in the context of how do we use them to hedge. So what I've just spoken about is how to use them as an alternative to buying stock. So again, if I wanted to buy 100 shares, instead of buying 100 shares, I could use one option contract and I could put again, just for simplicity, a 10% deposit down. I could just put a deposit down and reserve 100 shares. So if the stock was to increase $10, $20, $30, then my option will increase proportionally. And one of the attractions for me is that if I saw a 10% move in the stock price, that's going to be about $32. So a 10% move in the stock price to actually get a big enough return on capital. If I was to buy 100 shares, it's going to be 100 shares times $320. Whereas if I'm putting a deposit down, then that same $32 movement, I'm going to get a proportional value. And at that sort of size of movements, maybe I'll get up to about 80% of that move translated into the option. So don't get all of it, I get a proportion of it. So this is using options as an alternative to buying stock. It's less capital intensive. I get a lot of the benefits if the stock moves favorably. And then the worst case scenario, if the stock was to take a swan dive and it becomes Enron this time tomorrow, and it turns out it's a complete donkey, then the worst that could happen is I lose my deposit. So if I put a deposit down and it's worth $1,000, that's it. That's the worst that could happen. It does not get any worse. So my risk is defined on the entry, which makes it attractive. But that's great, Phil. How do we use it to hedge? Well, let's think about now the portfolio. So we're looking at SPY, which is the S&P 500. And this is the ETF for the S&P. Now, let's say that I've got, let's just say that I've got 10 positions on and they're all bullish. 10 positions on, they're all bullish. Doesn't matter what the stocks are for the moment, but let's just say that I've got 10 positions on. And if I've got those 10 positions on and I've got no bearish positions, but I'm worried, as I am, about the next and impending crash in the markets, then what should I do? Should I place a stop loss on my positions? Should I close them out? What should I do? My view on those individual trades may not have changed at all. But I'm concerned that there's some funny business going on with the market. So one of the strategies that we can use is something called a hedge. And the idea of a hedge is to protect a position or a portfolio without having to close the position. Does that make sense? So a hedge is to protect a portfolio or protect an individual position in case of an adverse movement. And that's what a hedge is. So in the case of a portfolio, and I would use it in a portfolio basis, and I'll go through an individual example in a moment as well. But if I was trying to hedge my position, so I've got 10 positions and I want to hedge the downside risk, a very simple way of hedging the risk is to buy a put. So if I've got 10 positions, I can, without explaining it in too much detail here because I'm already in the weeds a little bit, but I can work out what those 10 positions, the equivalent position to the S&P. So if I've got all S&P positions, then I might use the S&P. If I've got all NASDAQ positions, I could use the Qs. If I've got, more stocks in the Russell. So why the S&P? I'm just using it for example. If I've got more tech stocks than S&P stocks, then obviously you can use the NASDAQ. So what I can do is basically do something called beta weighting. So beta weight the positions. So what beta weighting is, think about it like a language translator. If you've got 10 positions, think of them like 10 different languages. So I want to convert the languages into English or SPY. So beta weighting, and most brokers will actually have this facility built in. So you can work out what your 10 positions are beta weighted to the S&P. Think about it like a language converter. You've got 10 stocks, 10 different languages, and you're just converting them to English or S&P. So it will tell you how many equivalent shares that you would have. So if I've got 10 bullish positions and I beta weight them to the S&P, it might turn out that I've got 300 shares, or more specifically, the equivalent of 300 shares of S&P 500 or the SPY. Let me pause there. Does that make sense? It's important for part one of our hedge. Does that make sense? Beta weighting, does that make sense? It's like a currency converter or a language converter. I just want to work out what everything means in one language. And again, if it was a currency, you're converting them all to one currency. If it's languages, is the one that I use, converting them all to the same language so that we can start to have this conversation. Great. So I've converted them all. Again, your broker will do this. It's the click of a button. And you can just basically do something called beta weighting in your account. And it might say that, okay, you've got the equivalent of 300 shares long. So in this case, I've got a bullish portfolio. So I've got the equivalent of 300 shares, whether it's with stock options or individual shares. But right now, I'm worried that the market's going to sell off. So this hedging, a little bit of a sidebar to the sidebar already. Hedging for me isn't something that I do on a regular basis. And the main reason is that I've usually got a mix of bullish and bearish positions in my portfolio. So I don't often have to worry about a hedge. And I'm always of the view of, well, if you're worried about the market selling off, why are you bullish? So it's not something that you would do on a regular basis. And the reality is that market crashes, they have happened once every 10 years. We've just had one. We're probably going to be looking at another retest when the economic impact comes in. But they usually happen once every 10 years. That's statistically reasonably accurate. A little bit of a fast sell-off over 2 to 3 weeks, that happens about once a year. So statistically, these things don't happen with a frequent occurrence. So if you've got a mix of bullish and bearish positions, if the stocks are going up, buy the dip. If the several stocks going down, sell the rally. That's how I hedge, by having a mix of bullish and bearish positions, just naturally in my portfolio. But let's just say that you've got long only positions. That's what we're doing now. So firstly, before you actually put a hedge on, what are your choices? If you're worried about a market sell-off, choice number one is close some of your positions, take some of your profits. But if your viewpoint is longer and you don't want to close your positions, then a hedge makes sense. I'm concerned that something funky is going to happen that's going to wipe out all of my profit on these 10 positions, because you might have a longer viewpoint. So in the short term, you would hedge and protect your positions. Again, it's not something that you do all the time. It's really just to help prevent, think about it, it's like insurance. It's like you don't want it to happen, but you've got insurance in case it does happen. I mean, the great thing with a hedge is you don't need to, unlike insurance, you don't need insurance all the time. You just need it when you think that you've got the biggest concern. So anyway, that's just my kind of view on hedging. It's not something that I do on a regular basis. I've actually got a hedge on now. We've spoken about that in the past. But again, just not something that I'm doing on a regular basis. But anyway, the scenario is you've got 10 positions on, we've got beta weighting, and we've got the equivalent of 300 shares long. Let me just tidy this up. We've got the equivalent of 300 shares long, and I'm worried that there's going to be a sell-off. I'm worried that something weird is going to happen. So the first thing that we can do, if I've got the equivalent of 300 shares long, I can do a full, just getting my little colors, I can do a full hedge. I can hedge off in its entirety the 300 shares. So I could buy 3 puts, which allows me to control 300 shares. So I could buy 3 puts on SPY. And this is why we beta weighted, because I've got the equivalent of 300 shares long in our hypothetical example. And I could very simply just buy 3 puts. And let's see, let's just go and quickly see how much that would cost, because at the moment it's a ridiculous price. Let's say I want to buy a hedge. I'm just quickly going to do this. I'm not going to explain the thing. Let's just say that we want to buy a hedge for 63 days. And we're going to buy a 3 puts. Oh, come on, open up. I just want to get an approximate cost. Come on, software. There we go. 63 days, that one there. We could buy a little bit out the money. So we're looking, let's just say, keep it nice and simple, $10 each. It's not quite, again, I'm just looking for simplicity more than anything. So they're going to cost me $10 per share each. So $10 times 100 shares. It's going to be $1,000 each. So it would cost me $3,000 to hedge my position. Let me say that again. To buy insurance, it would cost me $3,000. So is it worth the hedge in the current environment is the first thing. So let me just pause here. This, at its most basic, this is how you could do a very simple hedge, but on face value. And we're going to add to this in a moment, so it does make sense. But let me just throw a question out there. Does this sound like a good deal? Is it deal or no deal? Is it worth it at this point to buy insurance, essentially, hedge? It would cost $3,000 in this hypothetical example. Do you think this is a good deal? Give me a little yes or a no in the chat box if you think it is or it isn't a good deal. Just give me a... Yeah, Ezekiel. Yeah, no. So Ezekiel. Yeah, so no deal. Glenn's yes. Not a good deal. I think I can understand. It's a possible yes, depending on the individual status. I can see where, but on face value, it doesn't seem like a great deal. I suppose it really depends how much profit you've got in there. If you've got, let's just say, if you've got 20 grand's worth of profits, then the answer is going to be yes, it's a great deal. If you've got early stage trades, then depending on the situation, it's probably not a great deal. As I've presented it here on face value, I think you're right there, Glenn. It could be yes, depending on what you're protecting. If you've got a lot of profits, let's say you've got 20,000 in open profit, then yeah, that's probably a great deal. Probably a great deal. So I can see why you said that yes there. In my mind, these are probably early stage trends. Because of my own time horizon, I kind of made a presumption. So the probably early stage trends, I probably had them open for 10 to 20 days. So on face value, they're probably not going to be that much in profits. So most of the time, the answer is going to be no. It's probably not a great deal. So one of the things that we can do, and this is what makes it something that you won't do, and this is why it's not something that you do every time. Because for most people, most of the time, under normal circumstances, and you've got a small profit on a small number of positions, it's probably not worth it. It probably isn't worth it. But then if the situation dictates, then yeah, it may be worth it. But it's still, whatever the scenario, it's still going to cost you $3,000. It's expensive in the current environments. Now, I don't know about, for anyone who's familiar with options, this is actually expensive for options at the moment because of the weird situation. Options on SPY, they're very expensive. They're about 3 to 5 times more expensive at the moment because of everything that's going on. So this would be an expensive insurance policy, but if it justifies it, then it may be worth it. But on face value, most of the time, it's probably going to be a no. Why would you do that, Phil? You've only got 300 shares or the equivalent of 300 shares. What's the point? What is the point? So one of the things that we can start to think about is if we've got those 3 lots and it's going to cost us $3,000. One of the things that we can start to do is we can start thinking about, well, can I mitigate the cost? Can I mitigate the cost? Now, we've spoken about this in the past where we have different option strategies available to us. We've just spoken about right now just buying a single put option to help mitigate the portfolio risk. But now what we've got is we've got this new expense essentially. So how can we bring that cost down? So one of the things that we can do is to start thinking about what can we sell to pay for the insurance? What can we sell to pay for the insurance? And this is where things like credit spreads come into effect. Credit spreads come into effect. So what I can do is I can do a combination of both selling an option and buying an option. So let me just try and give you a visual. So if I'm going to buy a put, that's going to benefit from a downward movement. Let me do that again. I'm going to buy a put, and that would benefit from a downward movement. And that would be like selling short shares, essentially, the equivalent of. Now, if I want to try and finance the purchase because I've got $3,000 to either mitigate if I was going to do what's known as a full hedge. Again, my other choices are I could buy 1, 2, or 3 lots. So I don't have to hedge the entire position. I could hedge partially the position. So instead of 3 lots, I could do 1 lot and I could do a partial hedge. Let's just stay with the full hedge just for in the interest of simplicity, but there are other choices before we get round to it. So other things that we can do is I can start thinking about, well, what can I sell? I could sell a put at the same time. I could sell a put at the same time. Well, why would you do that? Because if you have a short position, in this case, a short option, what you're saying is that you will receive a credit. So if we were to, again, we're buying an option for $10 each, $10 per share. And let's just say that we sell the same strike, just for a moment, just for simplicity. We sell the same strike. And now I'm receiving $10 and they eliminate each other. But there's no benefit to doing that because when this option makes money, this option is going to be losing money. And we want it to act as a hedge. So what we need to do is create a spread, a little window of profit. So to counteract that, we could then buy an option that's further out the money to create this little profit window. That's the zone of profit right there, or the zone of loss and profits. So if price stays above the credit spreads, that's fine because this is insurance. We don't want this scenario to happen. But if it was to happen, we don't want to be losing more money. We want to minimize the risk. So we've still got risk, and the risk is going to be inside the spread now. But what we're trying to do is transfer the risk from the purchase over to the credit spread. So if I'm receiving, again, in this example, receiving credits, let's just say that we're receiving a $5 credit now. So $5 credit on the spread because I've capped off that little window. I'm still paying $10 for my single puts, but let's just say that I'm receiving $5 per spread, credit spread. So what I would have to do is sell a multiple of them to pay for the purchase. I'd have to sell a multiple of them to pay for the purchase. Now, this is insurance, remember. So what I can start to do is think about jigging things around. So if I'm going to collect, where's my little drawing tool? So if I'm going to collect $5 credits and create a window of opportunity, or collect a credit, and let's just say that this is $5. So I'm going to collect $5 for every credit spread that I that I sell. And then if instead of selling, my apologies, instead of buying a put there, I buy it further down. So I'm doing a few things at once here to create a hedge. So what we can do is we can still buy the full hedge, the position here. We can collect an income off these credit spreads that helps to finance the purchase of the puts. So what I want to do is I want to sell enough of these credits. So I'm collecting $500 for each of these spread. I want to sell enough of these to pay for the purchase. And it's usually at a ratio of 2 to 1 is kind of interesting. So if I'm going to collect $3,000, that will pay for my purchase of the puts. So now my insurance should cost me $0. I have explained this really poorly, folks, so my apologies for all of this. I can think of a better way to explain it, but it's with the benefit of hindsight. So my apologies for making this a little bit more complicated than it needed to be. One last time. Credit spread. Credit spread. So with a credit spread, you are selling an option, but it's defined risk. That's why it would be for a credit. It's defined risk. So if the price was to move down, you'll still lose money if it goes down on this spread, but you've received a credit for it. So let's just say that we can sell 6 of these. We're creating $500 per spread, and that will give us the $3,000 credits. So we've got a credit at this point. We've received $3,000, and that would allow me to then purchase $3,000 worth of, or 3 puts that will act as my insurance to cover my open long position. Now, we don't want the market to go down, but if I'm buying something for $3,000 and I've sold something that is $3,000, then my cost is $0. That's the point of a hedge. Now, we don't want the short side to make money. We want this to not be necessary. That's why it's insurance. That's why it's a hedge. But if the market stays above our hedge area, let's just say that it's about here. So if we do all of this at $300, so if the market goes below $300, that's where this hedge kicks in. If it stays above $300, it'll cost me nothing to have the insurance. If the market does go down, there's going to be a little bit of loss as it moves inside the spread, which you're always going to have there's always going to be some risk somewhere, but it's inside the spread. If it goes down, you're going to lose a little bit of money. But then this side is making money. And what that allows you to do, it allows you to not close the bullish positions, particularly if you've got stock. Maybe you've got a long-term investment portfolio. That's where this strategy makes the most sense. Like with this sell-off here, many people would have, and this is what I was actually advising this at around this point here. So many people who are phoning me and saying, Phil, what shall I do? The market's selling off. My portfolio, my retirement funds, my IRA accounts, my 401ks, they're in a hole. How do I stop the pain? Should I close my positions? This was a regular question that I was asked around about this point. And this is what I was suggesting to people. If you want the pain to stop, just buy puts. That's the most basic thing. You don't need any high finance degree to make that happen. Just buy puts. There's going to be a cost, but it's insurance. Now, if you want to then reduce the cost of the insurance, you can sell credit spreads. And again, this is pretty much what I was suggesting to quite a few people who have the long-term investments, the actual investments, not short-term trading, which is what I focus on. But this is just one way, it's two ways that we can actually hedge against any downward risk, any downward movements. And again, you would only do this either as the big move is started and you're wondering what to do next, which is what happens to a lot of people. It means that you can sit through that without worrying about it, without closing your position, because if that was to happen, then you're making money on those, on the puts on the downside. And that should theoretically mitigate either in part or all of your long exposure. And you can add in the credit parts so that it pays for it, so that you're reducing the transactional costs. So if you're worried about it, you can do the credit part. If the market is already in raging bear movements, then buying puts is the simplest thing that you can do to protect your investments, protect your portfolio, so that you don't have to close positions. Because I had many people that were on the brink of, insert your own expletives, on the brink of frustrations, on the brink of tears, that just didn't know what was going on, what to do. And this is the easiest and simplest thing that you can do to protect against the downside. Again, just first and foremost, buy a puts, and then you can start adding, how can we pay for the puts? You can do it later. You can do all of this as one trade. It's called a back ratio. And let me just say that. So if you want to do all of this as one trade, it's called a back ratio. Sometimes it's called a ratio spread, a bearish back ratio. And what that will mean is you will profit from a downward movement, and you can essentially have that insurance. It should cost you, if you do it with the credit elements, it will cost you nothing. You can set it up so that you actually maybe receive a couple $100. For the insurance package, you can actually make some money from this. Again, the idea is that, hey, if it stays, let's just use $300. If the market stays above $300, you'll actually make, I don't know, $50, $60, $80. It's not typically a profit strategy, but you can certainly do that type of back ratio strategy that means that you receive money for the privilege of buying insurance. And all you're doing is stacking different strategies. You're stacking a credit spread with a put, a purchase, and you stack those two things together. It's called a back ratio. That's where we're at. That's all I wanted to say. Again, I've been asked this quite a few times. Some of you are, maybe that was a little bit too much. And that's okay. Don't worry about it. For some of you, that was exactly what you needed to hear. I've had this conversation with several people through the week already. But the most basic thing, if you're kind of at the brand new, options are brand new for you, the simplest thing that you can do, as I said, is to buy a put that will protect your investments in the short term. And you can buy insurance anywhere up to 2 years. So if you're worried about the next 6 months or the next 8 months or even the next 12 months, you can buy a 12-month put, and that will act as insurance. And if you want to help finance it or pay for it, then you can stack on credit spreads to help pay for the purchase. There is still risk involved. So if there is a downward movement, you're still going to lose some money, but you're not going to lose all of your money. That's the key point there. And that's what makes it insurance. So to be fair, let me pause there. We're a little bit under time for a change. Does that make sense? What questions do we have? Or do you have any questions? But this is called a back ratio, or a ratio spread. You're selling one credit. You're selling, at its most basic, you're selling 2 credit spreads for 1 put. And that's the usual ratio. And you can jig them around a little bit to help pay for these things. And when you stack them together, that's called a ratio spread. And the idea is it protects against downside movements. If price stays above, then everyone's happy, but you've got your insurance and it won't cost you anything. Awesome, Glenn, thanks very much. I kind of caught myself partway through that thinking I've made it sound a little bit more complicated than it actually was. So thank you for bearing with me. This does fall under the advanced category. I don't often say it. I just think that sometimes option strategies, most people consider all of them advanced. But if you break this down into its component parts, what you're doing is you're buying insurance. The put is the insurance. If the market was to drop, you're going to have insurance. And that means that those hypothetical 300 shares that we had earlier, that means that you don't have to close your position. Again, why wouldn't you close it? It could be an investment. There could be tax reasons. There could be in a 401k, it could be in an IRA. There could be lots of reasons why you're not able to close your position. Because again, at this point of the market here, a lot of people were phoning me, asking me that very thing. So at its most basic, buy the puts. And then if you want to, like right now, if you felt that you wanted to buy some insurance, you could buy a put and then do the credit spread over here in that combination. Again, that's called a back ratio. I think if you're already in motion and this is happening, again, if we saw another sell-off, if that's happening, I wouldn't bother with the credit parts because the horse has already bolted, for want of a better description. So if two possible scenarios, if the market's already selling off, if it's already on its way down, if it looks like we're looking at the next crash, crash 2.0, just buy a put and buy enough puts to cover either parts or all, however much you want to hedge. You don't have to do a full hedge. You can do a partial hedge. And then your other choice is close positions, take profits. That would be an even simpler solution. But if you don't want to do that, then that can certainly do that. And you can do all of this on individual stocks. You don't have to do it as a portfolio. Let's just say that you've got a trade on, let's just go to Microsoft. Let's just say that let's just say that you've got a Microsoft trade on, like right now. Let's just say that you've got Microsoft. Let's say that you don't want to close that trade off. You want to keep it open. It's a nice long-term investment. You blah, blah, blah. You could do that put thing. You could do the ratios for it. You can do that on individual stocks as well, as opposed to the portfolio as a whole. So just a little bit of an afterthought here. So if you want to hedge an individual stock, you can do. If you want to hedge the portfolio, which is what I've done, that's the classic interpretation of a hedge. You pretty much cover everything. Right, folks, that's where we're at. As always, thank you for your time. Thank you for your attention. Yeah, I think we'll just leave it there. Yeah, thank you for your time. Thank you for your attention. As always, it really is appreciated that you've taken a moment to spend some of your day with me. So that really is appreciated. This has been recorded. So if you want to review it, that will be up in the Slack group later on. So if you're not a member of Slack already, all you need to do is go and join it. The link should be there if you've not got the link. It'll be posted in the portfolio workshop. It's only going to be available for a few days. I don't make them available forever. So if you want to rewatch it, then it will be in the Slack group later on. Yeah, that's it. Thank you for your time. If you've got any follow-up questions, if you've got any anything that you need, I'm pretty open about what I do, as you know. But if you have any questions, comments, or observations, appreciate all feedback. Just send me a message. Again, quickest way to do that is through Slack, or just hit reply on any of the emails that we have there. A lot of what we've spoken about and what we over these weeks is in the members area. We talk about the trend phases quite a lot, which is newly introduced, and we'll be adding to this the courses and the programs. Again, they're all inside the members area. But yeah, a lot of what we talk about there is inside of our members area.